Good evening. This is Ken Long at Tortoise Capital. We're going to take a look at another case study today using the RLCO Bollinger Band framework. This is from a live chat room case study we did today, February 14th, 2017, in symbol XIV. If you were in the chat room, you could have studied this or traded live along with us during the day. So let's see how it unfolded. So in the middle of the day at about 11:30, we observed this frame, and I've drawn in the blue lines and a green dot, and this is our quiz. So this is where you would stop the tape, and I'd invite you to use the RLCO framework and the Bollinger Band framework in our framing language to mark up this chart and to see what you can see. So if you want to do that, go ahead and stop the tape now and work it out. And then I'm going to reveal the solution we came up with. Okay, so moving on. These are the framework notations I made on the first pass. So item number one, I draw this dotted line from the dragon hump from the previous resistance level that was the big first collapse. I draw that across, and so you can see that our entry at 6 is just on this side of that resistance level, and our thought is that if we can get into that position while it's still orderly, then we have a chance for a breakthrough move should it get through that dotted line. So we like taking this position here. At 2, I've drawn this dotted line across to the one of the original blue line in the frame, and that just shows another secondary resistance level at the dragon hump. And you can see that our entry at 6 actually cleared that dragon hump. Now it also lines up. I'm going to leap ahead here to number 4. That lines up nicely with this framework number 4. Now framework number 4, the vertical blue line indicates where we're stalking, and the reason we're stalking is because we notice this Z3 pinch from 67.22 down here to 66.98. That's a 24-cent Z3 line pinches. The Z3 is the Bollinger Band with 3 standard deviations, looking back 30 bars, and so that has compressed to less than a frog box, and so that tells us that we have an unusually tight range compression here, and so breakouts from that range, we call that a Z3 pinch breakout, and then that our entry is at location number 6. So number 4 then, the top line maps nicely to this resistance level, and so that gives me an extra belief that should price break through that not only is it breaking out of the Z3 pinch, but it's also breaking through this resistance level. And I like it that if it can get through this resistance level at number 1 at this dragon hump, we have a chance for it really to go. So that's 1 and 2 and 4. Let's come back and look at 3. 3 is a series really of 3 higher lows using the dragon belly down here at the bottom, and this also works for the baby dragon belly too, but I'm showing it with the dragon belly. I'm seeing a low, a higher low, an additional higher low, and so that feels like it's moving up. This gives additional power to the belief that 6 could be a breakout that goes. So number 4 we've seen is the actual frame of the Z3 pinch. 5 would be a stop at the Z2 Bollinger Band. So if we're entering here at Z3, I don't mind a stop that's outside the Z3 pinch, but I also don't mind the Z2 initial stop. This is where I place my initial stop. So we're at 67.02 with an entry at 67.24. Call that a 22-cent risk. And that's on a position sizing we would use 60 cents if we're using the full frog box. And so if we actually got a stop and reversal here at 5 or at this southern blue line, that actually is only representing a 0.3 of an R adverse move because of the difference between an execution stop and a position sizing stop. Now at 7, what I am noticing here is that price has left the resistance line here. It's broken through the resistance at number 1, and so at number 7 I feel really good that we could see a move. I'm noticing the dragon has left the river, the RL30 has left the river, the 10 has left the river, and so this is the beginning of trending behavior at number 7. You can see that the Bollinger Bands are starting to get wide. Even this early, I'd be willing to tighten up my execution stop maybe to just inside the Z3 pinch line because of the favorable price action. This is one that I don't want to turn and run against me. Now, this chart shows the same thing, and I've added now the text to the numbers 1 through 7. It says the same thing that I said before. I would just notice in passing that these yellow lines do represent some price moves. Now, we didn't take them during the day, but these are price moves that are certainly tradable in XIV and not unusual kinds of behavior. Also using that RLCO framework, in this case, breakdown of and a pocket entry here on a collapsing dragon, and then covering just short of the RLCO. Then a pocket entry can go long and exits at this pocket, which can be a stop and reverse on the RLCO, and then covering at the edge of the dragon. So all of these are tradable. I just show these because we're here, and why not? But again, the key things for me that mapping the resistance levels, the rising lows, the Z3 pinch frame, the extra reason to get in at 6 because of the proximity of this resistance level and the fact that it's broken through the Z3, which tells me if it can get to 7, then that's going to be very favorable. With an initial stop here at 5, and by this time I'm looking to tighten up already. And this slide deck is available in our chat room for folks that want to take a closer look. Well, as this trade unfolded, this was at entry at 6, and we would get to to a tightened up stop in here. We get a sideways quiet channel starting to work, and then get another breakout. When we get to 67.64, we get a breakout of consolidation, and then a 1, 2, 3 continuation. This is a place where we're long at 67.24. This is 67.66, so we're already an execution R in hand, and a second powerful leg up, and just the day starting here. We're just coming out of lunch, and we had a nice big gap up in the morning. So this is one that feels like it could really start to run. So we go ahead and take that second position, risking market's money from that first move, and you can see our initial stop. And so this is about another move of that magnitude. And I would take the second position, place my all-out stop right here. So even if this collapses against me, I exit both, and then the first one pays for the fractional loss on the second one. So I still remain in the money, but I've got 2 positions on, and pretty soon we'll see this thing get free and clear. Next thing that happens is we get another nice move up, a pull back to the edge of the dragon, and then a third leg starting. And on this extension, feeling the power of this move that had been so quiet. So we take that third position, put our stop in here. So again, if this one collapses, we're all out on all 3, and then the first 2 certainly pay for a fractional loss on the third one. But if it takes off, we've got 3 positions all in the money and starting to work for us. Well, as this one unfolded, we actually got a 4th leg up, and we get a 4th position in here at 68.45. Another hesitation, another leg running up, and then an RLCO outside the river, and then bottom ticked here on this reversion back towards the mean. I was happy to get out of this position at 68.70. Just briefly to note, it didn't fail below the Bollinger Band mean. It was still early in the day. It had not quite yet moved a range stat off the low, so there's still more room to go on this one. And with the being flush with market's money, it's willing to put a 1 position back on in the usual way on a continuation pocket entry. We get another RLCO outside the river. Now the 30 is rolling over. This is an owl pattern forming the other way, and now there's a potential trade move from here with a target down to 67.70 back to the VWAP. Because of the magnitude of this move, this now sets up a nice potential owl entry. So our entries then 67 and a quarter, and using just we'll even be more conservative, call it a 30-cent I stop, placing the if you went with the stop down here at Z3 instead of Z2, I'm being more conservative here. We got our a 30-cent I stop, so 67 and a quarter up to 68.70 is $1.45 on 30 cents, is darn near 5R on the first one. So this is probably 3R, maybe 2R, and another R. So this is somewhere north of 10R from 11:30 to 1 o'clock, and with a healthy scratch here on the backside. And the point that I want to really make here is that the lessons learned is that they all look the same when they're leaving the station. So this is the train pulling out from the train station. And so if we go back and look at this original trade frame, this is no different than any Z3 pinch box that we ever experienced. Do they all look like that? No, they don't always unfold like that. It's a relatively rare occurrence compared to the number that stall and fill, and which we're managing carefully using our signals. But there's no way to distinguish on the front end. So, hey, just let me take the Z3Ps are going to run that I can get 4 positions on and earn better than 10R. That doesn't happen. You can't tell from this location that anything like that's going to occur. The market has its own logic and means of expressing itself. So by paying attention to the trade frames, knowing the power that's embedded in price structure, with the use of the range stat to tell us what those excursions might unfold to be if it really uncoils, we play the trades and are prepared for that. We're prepared to be surprised into those positions. We let the market action trigger the criteria to get our second, third, and in this case, fourth position in. And we worry about managing our risk as opposed to trying to predict which one of these is going to work. And so we get surprised into that position rather than trying to predict that position. So that's what we mean by they all look the same leaving the station. By the way, the sketching really helps lock in the emotional lessons learned here, the feelings, the experiences of the idea. And so I encourage folks to sketch and to release those visual cues to help lock in those lessons and convert them to memory. So we thought that was the deal. Now, in the rest of the day as this thing unfolded, here was that owl pattern that we just spoke of. Well, it never did get down to the VWAP. The VWAP kind of continued to glide up slightly, and we get another Z3 pinch happening. And so now with still about half an hour left in the trading day, we said, let's take a look at framing this trade. And this yellow box is just right around a single range stat. So it hadn't even moved a full range stat, although I will acknowledge it's pretty close. But that is the maximum reasonable intraday move we can expect. So this was not an irrationally exuberant move. We've actually seen XIV and VXX go larger on a percentage basis than this, which is one of the reasons we like trading it. And so the challenge in the chat room was to structure this trade using the RLCO Bollinger Band framework once more and see if there's more in here. In this case, we would be looking for a retracement back to the VWAP, or if it breaks out to the upside, if it can get through the RL270 in this previous drag and hump, then it could express itself all the way to 69.40, which would be the range stat move, and so you would see an entry around 68.90-ish, and then looking for 50 cents to the upside as a range stat move. Now, one of the things we know that is, if it can get through a range stat move, you can see another couple frog boxes on the upside. So that's the boundary of irrational exuberance. Irrational exuberance begins where the range stat ends. So it is a rationally exuberant move from the low of the day to the high, but that's the boundary of rational movement. It can get beyond there and remain irrational for quite a while, but we don't count on it. So we would play this one expecting it to fail at 69.40, but if it didn't, then we know we might really have a runaway train going north. As this thing unfolded, the Z3 pinch breakout occurs, and you get an entry around 68.97-ish using the far side of the Z3 pinch. Another 30-cent stop. You get one leg up. It doesn't fail back. It resumes. I wouldn't be offended if you took the exit at the yellow dot and cashed 40 cents on a 30-cent risk for an R. But because the RL30 didn't even budge and the 10 didn't come through the dragon, I'm also not offended if you hold on to that. Then as we're running out of daylight here and you get another pair of these dragon horns, that's when you get two spiky moves north of the Z2 and rolls over, then go ahead and take this exit. Happy to get it at 69.54. So almost another 1.5 R just in this afternoon move after this sideways quiet channel. XIV was very good to us today. Our rule set was good to us today. What I was pleased about was the attention to detail in constructing the trade frames using perspectives to look at both sides of the trade, estimating reasonable reward to risk ratios, managing stops correctly, managing second, third, in this case fourth positions correctly, taking the exit where it's indicated, and then being back in the zero state quick enough to take what ended up being a scratch trade, because that's the right thing to do, and then being able to still have the cognitive effort to wait for the Z3 pinch to occur again and unfold, and then notice the move that gets right back to that RL270 long-term fair value in our charts. And so this selling right here was not only the dragon horns, but also, and running out of time, but also it gets right back to fair value at the RL270. And so this is looking pretty good in XIV. If you were in the chat room yesterday, you know that we closed our swing trades positions yesterday because of the extended move on a swing that it's made, and the feeling that this is getting a bit extended, and so we've locked in those profits on the swing, but we're still continuing to trade this thing with the turbo positions intraday. We're just not holding these positions overnight because the size of the gaps have been increasing, and there are some storm clouds brewing in terms of the size of the short positions in the futures market for volatility, and that says there could be some sudden, sharp, adverse volatility spikes against the equities, which would punish XIV. So I don't want to hold those overnight. But that's another lesson for another day. This was today's case study quiz, brought to you from the good folks there in the Tortoise live chat room trading laboratory. And thanks to all the traders working so hard every day at refining their craft. So take good care. Keep your risk measured and your powder dry. Be a good person in your community, and take care of yourselves and your family. So good trading.